Good evening, everyone, and welcome to the Brian Crombie Radio Hour. Tonight, we're going to talk to Karl Schamotta. He is the chief market strategist at Corpay. He's someone that I follow pretty religiously on LinkedIn and other places because the guy's always got some interesting commentary on what's going on with the economy, with interest rates, with exchange rates, with housing. Everything just sort of economic related. So I thought we'd do a sort of an overview of what's going on. Karl, I got to ask you. Last week the Bank of Canada reduced its interest rate, and yet the Canadian dollar went up. I thought that it would have the opposite impact. What's going on?
Yeah, a lot of fun things are going on in markets right now, that's for sure. The first thing I guess I should point out is essentially what happens in financial markets in general, and that is that mostly we have a event in the future, and market participants trade ahead of that. They trade on what their expectations are for that event. And so what happens on the actual day of the event is that we see a small calibration, right? We see a small adjustment in market pricing based on what happened in the event relative to expectations. So that's a long-winded way of saying that retail traders often get this really, really wrong because they think that markets are simply reacting to whatever just happened as opposed to the buildup in advance. And so the key thing that was going on ahead of this Bank of Canada announcement is that we did expect a very, very dovish statement. We expected Tiff Macklem and his counterparts to come to bat with a very sort of downbeat outlook on the Canadian economy, on employment, and on all of the other fundamentals that really go into driving monetary policy. And what we got instead was a little bit more caution, I think, than many had expected, right? So Tiff essentially suggested that the Canadian economy is likely to rebound a little bit into the fourth quarter of this year, and suggested that policy rates should come down, but not as aggressively as perhaps markets had been thinking. And so that has helped to boost the Canadian dollar a little bit in the short term.
But yet, most people, I think, want interest rates to come down, don't they?
Yes, and the
I
reality
thought
here
this
is
would have
that
been bad news.
no, no, not at all. I think at the end of the day, the markets are anticipating a lot of policy easing over the next year and a half. We have at least 7 rate cuts that are already priced in, and so
Seven.
that's yes, that's right. So that's very, very aggressive, right? That's another 3 rate cuts in the coming months, and then at least 4 over the next year and a bit. And so this is what was sort of setting the context for markets ahead of that announcement. And I guess the key thing to know here is that while markets have been very convinced of a dovish turn from the Bank of Canada, they were not anticipating the huge shift that we've seen in the US over the last month and a half. The non-farm payrolls report for July, which came out in early August, really, really impacted what we expected from the Fed. We've seen a lot more rate cuts put on the table south of the border. And so what has happened is that the rate differential, the interest rate gap between the US and Canada has actually narrowed a bit in the interim. And so all of that is coming together to support the Canadian dollar, despite the fact that rates are likely to come down in Canada and quite aggressively so.
So, the differential today is still large, but what you're saying is that it's expected to be smaller in the future. Is that correct?
Yes, and it has narrowed quite a bit from where it was a few months ago, and that's just on the basis of the idea that the Fed is going to do some catch up here. And that's very important to kind of put this to kind of put across is that the Fed started with a much, much higher policy rate, and has started to ease much more gradually than the Bank of Canada. And so there's more sort of delta or room to move on the US side of the border than there is in Canada. And so what this is really driving is not so much a change in anything here in Canada, but a huge change in global markets as we anticipate a more accommodative stance from the Federal Reserve over the next couple of years.
So give us a sense of where the Canadian dollar was, is, and where you think it's going to be by the end of the year.
Yeah, so the Canadian dollar had fallen quite dramatically by early August. In fact, we had a record short position against the Canadian dollar as of the end of July. So in other words, there were more people betting against the Canadian dollar than ever before in history at the end of July. And that has now come back. We've seen a big correction in the last month, partly as a result of that convergence in rate expectations on both sides of the border, partly as a result of what we call a short squeeze in the financial markets, in which people who are betting very aggressively against the currency get squeezed. They start to take losses on their bets, and they cover themselves really quickly. And partly on the basis of what we call a dollar smile dynamic in global currency markets. And yeah, maybe I'll explain the dollar smile.
Yeah, what the heck is a dollar smile?
Yeah, it's probably the most important relationship in global financial markets in the world, and has been for several decades. And basically what it suggests is that the US dollar tends to outperform, it tends to rise when we have episodes of extreme financial turmoil or an extreme recession that hits the global economy. And so why does this happen? Because most of the loans written in the world that are, crossing borders are written in US dollars. So everyone wants to repay them as soon as trouble hits. And it's something that happens because the US has the deepest and most liquid financial markets in the world. So when we want safety, every investor in the world essentially piles back into the dollar. So that's one end of the smile. The smile sort of, tilts up at one end because we have an extremely negative situation in the global economy. On the other end of the smile is where we've been for the last year or two, in which the U.S. economy is outperforming everybody else, and the U.S. Interest rate landscape is tilting upward. In other words, the Federal Reserve is raising interest rates. During that circumstance, also we see the U.S. dollar rise, and so that's the two ends of the smile. Now, under more normal circumstances, when the U.S. economy is muddling along, when global growth is neither super hot, nor super cold, that's when the dollar tends to fall. And so over the last month and a half, as the U.S. economy has shown signs of slowing, mostly in the employment market, but more broadly in consumer consumption and a couple of other variables, that has put the onus on the dollar to fall, essentially. So the dollar's been falling a bit, and that's been lifting virtually every currency in the world in relative terms. So sometimes when we see exchange rates move, it's got nothing to do with the country in question, but everything to do with what's happening in the US dollar.
I don't want to get political, but let me just ask you a question if I could, because I was a little bit struggling trying to understand JD Vance's comment recently that he wanted a lower US dollar. He didn't want the US dollar to be the reserve currency for the world. And so it almost sounds like he wants to be at the bottom of that smile that you were describing. But the way you described it, that bottom of the smile occurs when the US is muddling along.
That's right. So this is the fun part about the political situation right now. And yeah, I'm quite happy to talk about it because I do find that it's, how shall I put it, there's some cognitive dissonance currently in the Trump campaign's platform, right? So on one hand, they are talking about putting tariffs on everybody, on boosting the US economy, on doing lots of things that tend to push the dollar up, right? And then on the other hand, they're saying, well, the reason we have these huge trade deficits is that the US dollar is overvalued. And I would argue that they're correct in that sense. And so the problem is, what are they going to do to change it? There just isn't a lot of policy tools available to the Trump administration, presuming that, that they win in November, to actually push the dollar down. Most of the things that typically push the dollar down are against what they're saying in the rest of the platform. And in other words, they'd have to have a US economy that's underperforming. They'd have to have a situation in which interest rates in the US are, at least on par with elsewhere and perhaps lower than they are everywhere else in the world. Or they'd have to have a campaign of currency intervention. In other words, they'd have to be buying other currencies against the US dollar in order to have this all play out. And so the challenge that we're all going to have past November, if the Trump administration does come in, is interpreting this and trying to determine what are they going to do next from a currency policy perspective. It could be extremely dangerous and probably the closest analog that we've had is, somewhere around 1971 when Nixon was playing games with the dollar and with the Federal Reserve's independence. And so, markets are definitely bracing for more turbulence than they have in a very long time.
So with the interest rate decreases, and you're saying that we've got 7 more expected rate cuts in Canada coming, is the long end of the curve lower than the short end? Do we have a inverted yield curve?
Yes, we do, and we have had for quite a long time, right? So that inverted yield curve has historically preceded a recession, right? In the U.S. and Canada, right? We've typically seen a inversion of the yield curve 18 to 36 months before the economy heads into recession. And what's sort of I guess challenging right now is that we are seeing what we call a disinversion. I'm bringing in a lot of technical terms for a radio show here. I apologize, but what we are seeing is that short end is actually pushing back above now, and this is typically a sign that comes right on the precipice of a recession, right? So typically we see a recession hit within 3 to 6 months after we see the yield curve disinvert. Now the question at this point in time is: are we looking at the same rules that we always have had in the past, or is this time different? And I will remind everyone that John Templeton once said that this time is different are the 4 most expensive words in the English language. So we're tempting fate to think that anything different might happen this time. But the reality is that the post-pandemic economic landscape and the financial landscape are very different than what we've seen for the last couple of decades. So no one really knows right now if we are about to tumble into a recession or not.
I heard the comment once that an inverted yield curve has predicted 19 out of the last 20 recessions. Is that sort of an accurate comment?
That is, but also, markets do have predicted, 10 out of the last 3 recessions. We can kind of flip that on its head and say, the reality is that markets often do take a more bearish view. We do tend to see, markets overcorrect and sort of overreact to incoming data sometimes, and so it's very difficult sometimes to know what's going to happen in the future. And in fact, if you really look back at the last couple of years, right, all sorts of people have thrown lots of, sort of shade at central bankers, at policymakers, et cetera, for making the wrong decisions. But the reality is that the financial markets have screwed it up repeatedly and massively over and over and over. They've gotten it wrong. For example, this year, the Federal Reserve was expected to deliver 10 interest rate cuts back in January. And as you know, that has not happened. So the question at this point is whether we should be trusting the financial markets or trusting more anecdotal evidence, more of the conversations that we have with each other about where the economy is headed.
Why hasn't the Fed reduced interest rates? The economy in the United States has done better than they expected. Is that why?
Yes, the U.S. economy.
Welcome back, everyone, to the Brian Crombie Radio Hour. We're chatting with Karl Schamotta. He is the Chief Market Strategist at Corpay. What do you do in your job, Karl?
I'm a currency strategist fundamentally. So what I try to do is understand where currencies are going to go in the long run, and I help to build strategies for corporations who move money across borders. So fundamentally, what's going on typically is a company is moving money, from Canada to the U.S. or vice versa. They're doing import or export. And they're worried about, firstly, trying to get the best value that they can get for the money that they're exchanging, and secondly, protecting against risk in the future. So a large part of my role is focusing on where are the surprises, where might things go a little off the rails, and where might that impact the Canadian dollar or currencies more broadly.
And who and what is Corpay?
We're a very large payments firm based out of the US. We're part of the Fortune 500, and we help both companies in the US, so a lot of companies in the US with their fuel card programs and things like that, as well as companies around the world who are moving money between countries. So we have a very large global footprint, offices all over the place. And yeah, I think it's one of the most entertaining companies to work for. I think out there, simply because we do have that footprint, right? We get to talk to a huge variety of people in the global economy, and we get a really great read on what's happening under the surface as a result.
You posted an interesting cartoon the other day on LinkedIn that said there seems to be no sign of intelligent life anywhere. Why are
Yes.
you saying that?
Well, I was making fun of myself. And the weird thing is on LinkedIn, I can't really tell if it actually connected to my previous post. So the reason is that so on Friday morning we had a non-farm payrolls report that did not sort of create a conclusive case for a half point rate cut from the Federal Reserve in September. And so to simplify that a little bit, there was not a big slowdown in jobs. There was not a big, positive surprise in jobs. It was just sort of in the middle. It was pretty neutral, right? And so I went on LinkedIn to say, I don't think that this makes the case for a 50 basis point cut at the September meeting. And therefore, I would expect that Fed policymakers don't that they talk down the prospect of a 50 basis point cut instead of and favor a quarter point cut. And so then maybe an hour later, well, no, sorry, I guess about 2 hours later, Chris Waller, Governor Chris Waller on the Fed Open Market Committee, came out with a speech, and he sort of seemed to suggest that he would be willing to do a 50 basis point cut. So in other words, my call was wrong with like within an hour and a half. And this is something that you get used to as a currency strategist. It is a humbling business to be in. We rarely get things right, and I try to be humble about this because I do see a lot of financial commentators out there who are I don't know how to put it, but they're a little bit overconfident in their own skill and ability, right? The reality is that very, very few of us are able to predict what's going to happen in the future. Now, the fun part about yesterday's post there is that the reaction in market shortly after Waller's speech was in line with what I had originally said. So I didn't look quite as stupid as I thought I did at the 11 o'clock point on Friday morning.
So we just chatted before the break about what's happening with the U.S. housing market. Let's talk about the Canadian housing market for a minute, if we could. You're saying that you think that there's going to be several additional rate cuts. I think you said 7 in the United States. I'm not sure how many you think there's going to be in Canada. And if that's true, then it's going to be a lot cheaper to borrow in the future than it is today. The pre-construction condo market is in crisis right now. It's dead. Some people say there's softness in even the single family housing market. There's assignment sales on a fairly regular basis, which suggests that people are really not buying or not buying a lot today. But if you're right that the rates are going to come down, shouldn't they be buying now? Because rates coming down in the future means that prices are going to go up in the future?
Not necessarily. And so this is the fun part. It's always great to talk to you, Brian, because I know you and I are of a similar intellectual vein on this stuff. I think I started publishing charts on the imbalances in the Canadian housing market at least like 12 years ago, something ludicrous like that, just showing that Canadian house prices had gone up by way too much in the years, well, really in the last 15 years. And so what is going on right now is a bit of a correction, right? We know that the difference between house prices and incomes in Canada had gotten way out of line and became increasingly difficult to sustain once interest rates went up. Right. The fact that borrowing costs have gone up so much in Canada is partly a function of interest rates, but it's mostly a function of the notional value that Canadians have borrowed. In other words, their mortgages are way too big. And many people are in too much house, put it that way. And so we are seeing a bit of a correction here, and that I would expect would continue, right? The reality is that interest rates going down in the future is already priced into a big part of the bond market, already priced into mortgage rates, and is slowly percolating its way down. So what is very, very likely, going forward here, is that the past effects of monetary tightening, the past effects of interest rates going up very quickly, is going to continue hitting the Canadian housing market for a while. And then we'll begin to see the impact of rates going down beginning to hit the Canadian housing market. In other words, the whole thing is very lagged. It doesn't happen, instantaneously. Sometimes it can take 18 to 24 months for an interest rate cut or increase to transmit itself into the real economy. So now I say all of that, and yet there's a couple of other things that kind of matter here, right? One is that the narrative has shifted, for much of the last 2 decades. Most Canadians, pretty much 2 generations of Canadians, have become accustomed to ever increasing property prices. They've decided that they don't need to invest in anything productive, and instead they should invest in homes. That big narrative has taken a knock. The immigration story is pivoting. So for a big part of the last couple of years, the story across real estate markets in Canada was that we were going to see, large amounts of net immigration pushing up demand. We know that the political tides have shifted there, and that is likely to become less of a upward impetus in the years ahead. And then fundamentally, beyond all of that, what we do need to see is a rise in incomes. We need to see a continued rise in Canadian productivity in order to justify home values where they are. So my view is that over the very long run, we're looking at a housing market that comes close to plateauing. I don't think we're going to see, a 30 or 40% collapse in prices this time around, but I also don't think that the heyday of 10 to 15% gains on an annual basis is going to come back, for at least a decade.
Your comment about the interest rate changes having a lag of 18 to 24 months into the real economy is interesting. Can you explain why that lag occurs?
Yeah, so the big issue is that a large part of the financing structure in a modern economy happens at a remove, right? So it doesn't happen as soon as an interest rate goes down or up. And the monetary policy settings that are being set at the central bank are being set in reaction to what they're seeing in the economy. And so I think it was Friedman, one of the economists back in the 70s, who likened it to a person standing in a shower, right? You're trying to get the right temperature. You turn the dial too hot, and you scald yourself. Then you turn it too cold, and you freeze. And then you adjust it until you get to somewhere close to where you want to be. And the problem is that the central bank has been engaged in that process for a little while. The banks are downstream of that. The lending process is downstream of that further. And then the consumer sort of psychology is downstream of all of that even further. So consumers are responding to a whole bunch of signals from the economy, not just the interest rate, right? They're looking at, like, can I get a job? Am I going to see wages going up in the years ahead? Do I feel stable in where I am at? I am in the economy. All of those factors, sort of mean that a central bank can say something today, and it can take months and months, and if not, and sometimes years before that actually changes something in the real economy. The cliche in central banking is that monetary policy always operates at a long and variable lag. In other words, they don't quite know how long it's going to take for a interest rate change to actually impact the real world.
You said a couple of minutes ago that you didn't think we'd have a 20, 30% decline in housing prices. Back in 1990, I think that, lots of people thought we were in bubble territory, but most people said it's going to plateau. And there was only, from my memory, only one economist that called for a 20 to 30% decline. And that one economist was right. Everyone else was wrong. So why do you think there's not going to be a housing collapse?
Yeah, I don't think that we have, Put it this way, I think that there are big forces in the global economy that mean that capital is going to remain relatively abundant for a while. What happened in the early 90s was that Canada didn't just suffer from a huge interest rate increase, which really happened in the 80s, but it also was suffering from a constriction in capital flowing into Canada. So Canadian bond rates went through the roof. There was concern about the government's fiscal position at the time. There was concern about where Canada stood in the world and in the global economy. There was a lot of sort of negative headwinds there that resulted in money flowing right out of the country. And so this time around, we're not looking at quite the same drag. Now, all of that sounds like I'm some kind of Pollyanna, I'm sure. But the reality is that Canada is in very dire straits. We are in a clearly imbalanced economy that has spent much of the last couple of decades focused on building houses, renovating our kitchens, doing things like that, as opposed to building world-beating companies and generating more income. That process needs to sort of unwind. We need to rebalance back toward something that's more sustainable. That's going to be painful, and house prices are going to have to, remain relatively stable for a long period of time in order for us to get back to an economy that serves the needs of most Canadians. The reality today is that a lot of the political change and sort of discontent that we're seeing out there is being generated by that over-financialization of the economy.
What do you mean over-financialization of the economy?
Yeah, so I think basically what has happened, if we look back over the last couple of decades, is that everything in the economy has been turned into a financial asset. So home prices, commodities, all sorts of asset classes have been turned into things that go up and down with the shifts in global risk appetite and with changes in global interest rates. And so what happened was that the price of assets went up and up and up, even though the price of goods was going down and down and down in real terms, right? So when we look at inflation overall for most of the period running up to the pandemic, the cost of manufactured goods was going down, right? But meanwhile, financial assets were going up, right? And your house price was going up, your equity portfolio was going up, all sorts of things were going up at the same time. And so that created a huge imbalance, right, between the things that sort of are productive, that generate income over the long run, that generate innovation, as opposed to the things that are just sort of inert assets. And the way I like to think about this, by the way, is that basically for most of the last 3 or 4 decades, the things that have gone up in value are things where governments have bottlenecked supply. So this is, whether you look at homes where, governments have put a lot of regulatory red tape in the way and it's very difficult to build them, to education where, colleges and universities have a huge sort of bureaucratic overload, right through to commodity markets where, in some cases it's just very difficult to, build a new mine or extract resources to extract oil and things like that. Those are the asset prices that have gone up in value. Meanwhile, anything that people are manufacturing or are providing as a service that is, largely free of government intervention has generally gone down. And we're beginning to see that pattern reassert itself right now. Manufactured goods are, disinflating, and commodity prices are very weak again after the big run up during the pandemic. So long story short, the issue here is an imbalance between the things that are exposed to lots of competition and relatively little red tape, and the opposite.
And yet, with all the economic sanctions that we put in place because of global geopolitical issues, and frankly, tariffs. Just last week, the Canadian government, what did it do? Announced 100% tariff on Chinese electronic EV cars, and Trump is talking about huge tariffs against. Aren't we going to have? Are we going to have more government regulation in exactly the areas of the economy that you're saying there hasn't not been government regulation?
Oh, there has been, yeah. So like the issue now is that that governments are getting into those areas that have traditionally flowed pretty smoothly, right? And I would expect that to continue. The reality is that both ends of the political spectrum are acting more interventionist. It is kind of funny that everyone's talking about like the huge stakes ahead of the U.S. election, given that people that like both of the candidates on both ends of the spectrum are big government, big spending, big intervention fans. The reality is that we're looking at a more challenging landscape. No question of that. And the offset to this is that we may be in a world where enough political pressure has been brought to bear to move governments out of housing markets, to ensure that they do more streamlined approvals and things like that. And I know that you're an expert on this. You've talked to a lot of experts on this. It's a slow moving process, but I do think that it is clear at this point that we have to do something to cut the regulatory red tape in housing markets, and that there's political will on both ends of the spectrum to do that. So yeah, you're looking at a potential rebalancing over the decades ahead toward more tangible things going up in value, while things that for the last 2 decades have lost in value actually lose out, right? So in other words, we could see inflation coming from very different things in the years ahead than we have seen for really most of the post-2000 period.
Fascinating conversation tonight with Karl Schamotta, who is the chief market strategist at Corpay. We're going to take a quick break for some messages and be back. We're going to talk about sort of where the economy is headed, and what we can expect from government, because it sounds like, if anything, Karl is suggesting we need less government, and government's the problem rather than the solution. Wasn't it Reagan that said that? I don't know. We're going to take a break. Back in 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour. We're chatting with Karl Schamotta. He is the market strategist at Corpay, and we're talking about the economy. Karl, I got to ask you. You talked earlier about the U.S. economy doing extremely well, and then we also talked about sort of government deficits and debt, and you described what happened to Canada in the early 1990s as a real challenge with huge government debt, deficit, etc. The U.S. economy seems to be doing extremely well, and the what was it? The Inflation Reduction Act, the Infrastructure Bill, a lot of the things that people are criticizing Biden for and calling it Biden economics seems to have actually worked and helped, and created huge amount of government deficits. But while we criticize government deficits, it seems to have created the best economy in the world. So how do I reconcile those two ideas, that government involvement, government deficit financing, and intervention effectively is bad, but yet the U.S. economy is doing so well? And then we take a look at Canada, and we're not being as interventionist, and yet we criticize the intervention that actually occurs. While the best example would be maybe we should become more interventionist, and then we would have an economy like the United States. Like, how do I reconcile that?
You know what? I think you're really speaking to my coffee habit here, Brian. The reason that this is not a good fundamental way to approach the economy in the long run is it's exactly like hammering a bunch of shots of espresso early in the morning and then continuing to do it all day. You just can't continue to do that. The system eventually breaks down. Eventually, your body can't take any more, and resources get very badly misallocated. And so the problem with government spending in general is that—
So Biden's been taking too much coffee?
I think so. Well, you can't really tell from public appearances, but no, I think though at the end of the day that if we look at this desire to do a lot of government spending, it can help in a short run sense. And most economists think that we should be doing counter-cyclical increases in fiscal spending. In other words, when we hit a recession, we should see governments increase their spending, but they should go back to normal afterward, right? And we did see this to some extent in the U.S. During the pandemic. Basically every government in the world went to wartime footing. They spent a lot of money, in a very short period of time. That helped to put a floor under the global economy. That helped us to, sort of stage that rip-roaring rally back after the pandemic, which was, it could have gone another way, right? If governments had not done that, we might very well have slipped into something like a depression, right? So there is a positive role that can be played. However, in the long run, when governments are doing most of the spending in the economy, there's a large amount of research that tells us that that spending is often put into the wrong sectors and fails to actually induce competition, fails to induce innovation in the long run, and then we get an economy that is vulnerable to a downturn, right? And so the key issue here is whether this all continues, right? And I would say that I'm relatively optimistic at this point about where the U.S. and Canada are headed in that respect. It does look as if the political winds are shifting, and that support for huge amounts of government spending are beginning to fall off. However, as we discussed in the previous segment, the reality is that it seems like support for government intervention still remains extremely high. It does seem as if there's a lot of support for trade actions. There's a lot of support for, subsidizing specific industries, harming others, and doing all of the sorts of things that are, I guess, less compatible with a capitalist system in the long run.
Can I ask you a question? If
Sure.
climate change is one of the biggest problems we've got, why does it make sense to put 100% tariff on Chinese electric cars?
Because clearly politicians don't really think that climate change is the biggest problem that they're facing, right? They think that the biggest issue that they're facing is support from voters and support from a specific group of voters, right? Unionized auto manufacturing or auto workers, right? And so what we're seeing is politicians playing to a very small segment of the overall employed population, and doing everything they can to support that particular group, right? And so I think climate change is simply a talking point for many of this breed of politician, and they're really responding to the incentives that are in front of them. Now, all that said, the issue that we have among politicians today, and among, I think, virtually everyone in the Western world, is that we are dealing with a China that is quite intent on tilting the playing field towards its own favor in an unfair way, and the policy tools that we have available to us all inflict potential pain on citizens in our countries. In other words, we would have to change our taxation policies. We would have to dramatically curtail the flow of credit to households. We'd have to do a lot of things if we wanted to ensure that Chinese exports were not as competitive in our markets, and that I guess domestic manufacturing industries could stay afloat. The reality is we're in a very difficult situation, and politicians are choosing tools that only get us partway there in terms of addressing that problem.
So you think that the Canadian dollar has done better of late, and I get the impression that you think it's going to continue to do okay. You think interest rates are going to come down in both Canada and the United States. And you're talking about 7 potential interest rate reductions. You're talking about that the market is expecting, I guess, a soft landing, even though the inverted yield curve 19 times out of 20 would suggest that it's a recession. But you're saying that the market overestimates how often recessions occur rather than the actual occurrence of recessions. You're saying that you don't think that there's going to be a housing collapse, but you do think there's going to be a housing plateau. So what does that mean for the average Joe, the average person? What should we be doing? Should we be buying homes or selling homes? We should be investing in the stock market. The stock market seems to be still high. What's your advice to the average people listening to our show tonight?
Yeah, so I think just one quick correction there. I do think the Canadian dollar is outperforming expectations right now, and it might, rise a little bit in the next month or so. But in the long run, due to many of the reasons that we were discussing there, I think the Canadian dollar underperforms. I think it actually weakens from where it is today, and that is, in line with poor productivity, that big sort of indebtedness overhang, and the fact that we do have to rebalance away from the housing market towards something else. Anyway, but yeah, if we think about the average person, I think, is well served to invest in productive enterprises. In other words, to invest in the stock market in the long run, as opposed to putting all their eggs into the real estate basket, or into things like Bitcoin or gold or something like that. The value that is generated in the global economy over the last couple of centuries has very clearly come from productive, innovative companies that expand their revenues over time, right? And the stock market is a fantastic way to articulate that. So invest in the stock market, and ignore it for as long as you possibly can between times that you look at the statement. And you're very much more likely to outperform than you are if you try to focus on the things that have run up very quickly in very short periods of time, or things that fundamentally are apocalypse bets. If your thing is going to go up in value because the world ends, you probably have bigger problems out there. So instead, bet on the global economy continuing to be productive, continuing to generate amazing innovations, and to growing in the long run.
Even with the stock market at its current levels, you think investing in the stock market is the right thing?
Yes, in the long run. We know that we're going to see some volatility, and we know that there are parts of the stock market right now that are blatantly overvalued, particularly in the AI sector. But as long as you're putting money in for the long run, you're not going to be pulling it out, in the next 3 months. It is a great place to store your wealth, right? And so the key here is to use those opportunities, use those sell-offs that happen in the market to increase your stake over time, right? Slow and steady wins the race. Trying to, hit it out of the park all at once is just not a great investing strategy in the long run.
Carl, we've got a war in Eastern Europe. We've got a war in the Middle East that looks like it might expand. We've got potential friction in between Taiwan and China. How do you insulate yourself from sort of geopolitical issues, or do you not, and not worry about it and assume that Canada and the United States are going to be okay?
I don't think you can assume that we're going to be okay. And one of my frustrations, I think, living in Canada is that the average Canadian citizen does not pay nearly enough attention to what's happening outside of Canada, and outside of the US, right? We should be very much more interested and engaged in what's happening in terms of international relations and in geopolitics. But I also would suggest that the impact of those changes is slow moving at best. And if you look back at history, those who overreact to the sort of terrible headlines that come in all the time are often underperforming, right? There's a great chart that's made the rounds many times around, if you had listened to the bearish market strategists over time, or the bearish economists over time, if you had put money where they told you to, you would have lost your shirt many times over, right? The best bet in the world is to bet on the fundamental ingenuity of the human spirit. And that sounds very fluffy, but the reality is that, everyone goes out there every day. We all try to do our best. We develop innovations. We put them into practice, even if they're in, the tiniest, smallest ways. And that fundamentally, ultimately drives the economy forward. And so the thing that you should be betting on is all of that coming together with despite all of the terrible headlines that you see.
What an incredibly inspirational comment from an economist. Bet on the ingenuity of the human spirit. I love it. We're going to take a final break and come back with some concluding comments from our expert economist and inspirational, soothsayer in just 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour. We're chatting tonight about the economy with Karl Schamotta. He is the chief market strategist for Corpay, and he's obviously not only a very smart economist, but he's got some inspirational comments to say about the human spirit and ingenuity, and I love it. Karl, I got to put you on the spot. You know, we've had, I think, a really good conversation both this time and other times about what's going on in the economy. So what if you were the head of the Bank of Canada or even the Minister of Finance? What would you do right now?
Yeah, I mean, I think it is prudent to assume that we're going to have a lot of turbulence in the next couple of years. It is prudent to, if you're at the Bank of Canada, cut rates and provide more support to the economy, and to do that cautiously, right? If you're the Minister of Finance, it is prudent to lower overall government spending and to be very discerning about where you do spend money. And I think all of that is advice that also plays out well at the household level, right? When we're looking at a period of increased uncertainty ahead, it makes sense to be cautious, right? It makes sense to not overextend yourself. It makes sense to avoid the sort of patterns of behavior that got us into this position in the first place. And just to dovetail with a conversation I think we had maybe 6 months ago, the reality here is that Canada entered the pandemic as the most indebted household sector in the G7, and that is the downfall. That is the primary problem why, or the primary reason why we are having so much difficulty right now. So in the years ahead, it makes sense to delever, to be prudent, and to focus on to focus on spending what you're already earning, as opposed to going further over your skis.
I do think the comment you made about sectors of the economy that have been constrained by government action have done well from an asset appreciation standpoint is really important for people to realize, and wonder if this massive increase in housing prices has been because of low interest rates, and clearly that has been a contributing factor, but has also been because of government red tape and regulation. And when you think about the economy, Karl, and I'd be really interested in your point of view on this, in sector after sector, people, consumers, have voted with their money, with their feet, that government regulation hasn't been valued. When you think about government regulation in stock market, stock brokerage fees, in travel agency fees, in real estate fees, in building inspections of hotels, of medallions for taxis, and a whole bunch of different parts of the economy. When government has got involved to regulate and add red tape, and consumers have been given the opportunity to use Uber or Airbnb or book on their own, they've taken that opportunity. It's almost as if the people value far greater a whole bunch of likes or comments and online valuations than they do a government regulator saying one way or the other. And if that's true, then why do we have this huge amount of government regulation and red tape in, as you said, mining, in exploration, in housing, etc.? And maybe we should just unleash that human ingenuity that you talked about a little bit more. What do you think?
Yeah, I think the issue is the diffuseness of public opinion, right? So it is very difficult to get the broader public to agree on anything and to focus their efforts on getting something changed, right? Whereas if you're in a sector that wants to defend its position, so say that you're a doctor and you want to make sure that no other doctor can compete with you in your area, you're much more you're in a much better position to put specific pressure on politicians to change policy, right? And so across the economy, what we have is various sectors, professional associations, unions, even corporate leaders that are doing what we call regulatory capture, right? They're talking to politicians directly. They're getting the laws that they want enacted, and that as a sort of overall phenomena is working against the greater good of the average person. And so until we have a sea change in terms of sort of political philosophies and in terms of how votes are sort of assigned, this is going to be the case. Bureaucracy is going to get bigger, and we're going to continue to try to protect certain parts of the economy despite that overall drag that drags us all down.
Regulatory capture. I haven't heard that description before. That's excellent.
Yeah, it's definitely what we see in a lot of sectors in the Canadian economy. I mean, I'm sure you've spoken to people about this before, but if you're in, for example, telecoms or any of the sectors in which Canadian prices are substantially higher than their global counterparts, if you dig very very shallow below the surface, what you're going to find is a small group of people in that sector who are very much in touch with their politicians and who are able to sway the regulatory structure in their favor. And yeah, and I should say that all of this is in a bigger context, right? To talking about our earlier sort of distinction between prices that go up and prices that go down. Prices that go up are typically in areas where government constrains supply and subsidizes demand. So whether you think about the housing market where interest rates were low and we had CMHC, sort of ensuring lending, that's a type of situation in which we are both constraining the supply and subsidizing the demand. Meanwhile, sectors where there's a lot of open competition, those sectors are where we see prices fall. And so, yeah, long story short, the reality here is that we have to focus on our collective good as opposed to trying to help the specific sectors that scream the loudest when things go against them.
Karl Schamotta, thank you so much for joining us. If people want to follow your thinking, what's the best and easiest way to do that?
Yeah, I guess just hit me up on LinkedIn. Yeah, that's probably the best place. So definitely reach out there. I also put out a daily newsletter on foreign exchange markets. You can find it at www.corpay.com. So CORPAY. And yeah, I'd love to talk to people about what they're seeing in the economy and in the financial markets more generally.
Karl, thank you so much for joining us. Really appreciate it. And I frankly love your inspirational comment about believing in the ingenuity of human people and the human spirit. I think that's very inspirational, and I agree with it completely. So thank you so much. That's our show for tonight, everybody. Thank you for joining us. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca. All my podcasts and videos go up on social media, YouTube, etc., podcast servers as soon as the show goes to air. Good night, everybody. Thanks, Karl.